What is the difference between a fixed rate mortgage and an adjustable rate mortgage? Which one of the products is better? Hello and welcome to my channel. My name is Vlad. I'm a realtor and a real estate investor here in Metro Detroit. One of the viewers of the previous video had asked me to go into more detail around fixed rate mortgages and adjustable rate mortgages. Today we will unpack the differences, pros and cons of fixed rate mortgages and ARMs, as well as try to help you determine which one might be the right option for you. Before we begin, I would like to remind you to hit the like button, subscribe, and leave a comment about what you would like me to talk about next time. This greatly helps this channel and means a lot to me. There are a lot of mortgage products with different terms and requirements, and each one of them has a specific time and place when they are beneficial. Some examples of these products include conventional mortgages, FHA, these are insured by the Federal Housing Administration, VA loans, these are special mortgage products for veterans and those who served in the U.S. military, jumbo loans for high-priced properties, and many more. Additionally, all of these different mortgage products can have different terms, 30 years, 20, 15, and so on. But for the purpose of today's video, we will just talk about fixed rate versus adjustable rate. First, let's start with fixed rate mortgages. A fixed rate mortgage is a type of a home loan in which the interest rate remains the same for the entire term of the loan, which is typically 15 or 30 years. Something I found interesting is that US is the only country in the world where you can get a fixed rate mortgage for 30 years. There are some other countries that offer fixed rates, but none of them offer it for the whole 30 years. The main benefit of a fixed rate mortgage is the predictability and stability of the monthly mortgage payment. With a fixed rate mortgage, you will know exactly what your mortgage payments will be for the duration of the loan, which makes budgeting and planning for the future much easier. The amount you pay as your first mortgage payment will be exactly the same 30 years from now, which is pretty amazing if you ask me. Sometimes the mortgage payments you're making to the bank will also include property taxes and insurance. If this is the case, this is the only way your payment may change, if your property taxes go up or down, or if your home insurance cost changes. Additionally, because the interest rate remains the same, the total interest paid over the life of the loan will also be fixed, which can provide a peace of mind for borrowers who want to know exactly how much they will be paying in interest over the life of the loan. You can always make extra payments towards the principal of the mortgage to reduce the amount of interest you will pay over the life of the loan. One negative with the fixed rate mortgages is that generally they have a higher interest rates than adjustable rate mortgages, which can make it a bit more expensive in the long run. For example, here you can see that as of January 15th, the average interest rate for a 30-year fixed rate mortgage, which is the most popular type of mortgage in US, is 6.11%, while a 3-year adjustable rate mortgage, where your rate is fixed only for the first 3 years, the average interest rate is only 2.34%. On the other hand, we have adjustable rate mortgages. An adjustable rate mortgage, or an ARM, has an interest rate that can change over time. The interest rate is typically based on the benchmark interest rate, such as the United States Federal Reserve's interest rate, and will adjust periodically, usually every year. ARMs also come in different terms, for example, a 5-1 ARM, 7-1 ARM, or a 10-1 ARM. A 5-1 ARM, for example, means that the loan has fixed rate for the first 5 years, after which the interest rate adjusts annually. 7-1 ARM has the same concept, but it's fixed for 7 years, and 10-1 ARM for 10 years. Let's stop there for a minute and talk about a potential scenario. Let's say you got an adjustable rate mortgage back in 2015 with a nice and low fixed rate for the first 7 years. And on year 8, your interest rate has to adjust to whatever it is in the current market. Because we had inflation for the past year or two, the Federal Reserve had to raise all interest rates, causing mortgage interest rates to go up as well. Therefore, when 2023 comes around, your new interest rate will be 3 or 4 times greater. Here's a graph from the Federal Reserve showing you where the interest rates were in January 2022 and where they are now. This is probably the biggest danger of an adjustable rate mortgage, that if you don't keep an eye on the interest rate market and do not try to do something with your loan before the interest rate readjusts, you may be in big trouble with your new monthly payment. The main benefit of an adjustable rate mortgage is the lower interest rate in the initial period, the 5, 7, 10 years that we just talked about. This can be an advantage for borrowers who don't plan on staying in their home for a long time, or those who expect their income to increase considerably over time. Additionally, an adjustable rate mortgage can be a good option for borrowers who want to take advantage of the low interest rates in the short term with a plan to refinance their mortgage at a later date. It is important to note that interest rates on adjustable rate mortgages can be much higher than fixed rate mortgages, especially when benchmark rate increases, just like in the example we just talked about, which means that adjustable rate mortgages carry much more risk than a fixed rate mortgage. All of this means that the monthly mortgage payments can increase or decrease over time, making it more difficult to budget and plan for the future. Furthermore, because the interest rate can change, the total interest expense paid over the life of the loan will also be subject to change. When considering an adjustable rate mortgage, it is important to know that the length of the fixed rate period can make a significant difference in terms of the overall risk of the loan. The longer the fixed rate period, the more predictable and stable the loan will be. But it also means a higher initial interest rate. On the other hand, shorter fixed rate period carries more risk and uncertainty in the long run, but could provide a much lower initial interest rate. It's always best to read and understand the terms of the loan and its potential future adjustments before signing on an adjustable rate mortgage. Ultimately, whether a fixed rate mortgage or an adjustable rate mortgage is the better choice depends on your individual circumstances, goals, and risk tolerance. If predictability and stability in your mortgage payments is important to you, then a fixed rate mortgage may be a better choice. However, if you expect your income to increase over time and plan to stay in your home for a shorter period of time, then an adjustable rate mortgage may be a better option for you. It is important to do your research, consider your personal financial situation, and consult with a financial advisor to determine which mortgage is the best fit for you. I hope that these explanations have been helpful and I was able to clear up your questions. I wish you the best of luck on your home buying journey. If you do need help buying or selling a home in Metro Detroit, you can find my contact information down in the description below. Please leave me a comment on other topics you'd like me to discuss, subscribe, and hit that like button. Thanks for watching and see you later.